Hello, this is Lisa Kirchenbauer, founder and president of Omega Wealth Management, back with a special edition of From the Top, talking about what's going on out there in the banking industry. Wanted to share perhaps some different perspectives on what we've been experiencing over the last week or two. Some new things for you to think about, maybe things that you don't think about in your personal finances, but as it may impact thinking about your banking relationships and whether you need to be worried about the news that we've been hearing about. So first, is this a banking issue or is it a crisis? Well, I would argue right now it's an issue. We've averted crisis, but it's a little tricky, and I think it's a little early to know exactly how this is all going to unfold. One thing that I think is worth thinking about, because there's been a lot of controversy, debate about should the FDIC have bailed out the depositors at Silicon Valley Bank and Signature Bank. And I want to talk first about investors versus depositors, and then I want to share, I think, an interesting quote that came out of this past week's news. So first of all, I think it's important to understand, are we talking about investors or are we talking about depositors? There are the stock investors in Silicon Valley Bank or Signature Bank, and then there are the depositors who actually had money at the bank. Those are not the same things. Although there may be some overlap, they're not the same thing. And so who got bailed out? If you want to use the term bailed out, it was the depositors, not the investors. The Silicon Valley Bank stock and Signature Bank stock are basically worthless. While they're going through the bankruptcy process, if you were a shareholder, if you were an executive who held the stock, you're in trouble. Now, on the other hand, the people who were really bailed out were the depositors, the people who were trusting the bank with their money. Yes, were they over the $250,000 FDIC limits? Yeah, we'll talk more about that later, because I think there's some things for you to think about that may not be really at the top of mind for you. And that's really what From the Top is all about, is just taking a different perspective. When we think about the bailout, I heard a really interesting quote this week from Charlie Munger, who is Warren Buffett's partner at Berkshire Hathaway. And he had, in prior conversations, had said that capitalism without failure is like religion without hell. And basically the point being, you got to have failures in order for capitalism to work properly. Now, this week, fast forward, he was heard saying that what the government did to take care of all depositors at these couple of banks, regardless of whether they were above the 250 in 250,000 in insurance or not, had to be done, because otherwise, and I'm not going to quite use his language, it would have been one of the worst runs in banking history. And I too believe that personally, that this is the kind of thing that had to be done, like it or not. That doesn't mean that the investors in the banks or the stock were bailed out. Now, if we go back to 2008, in fact, there were companies that were bailed out. And one might argue in the pandemic in 2020 with the PPP loan money that there were businesses that were bailed out. This is very different. This was about protecting depositors so that we did not have a further run on the banks. So what happened really? So quickly, I think there's a few key issues to think about. There are the financial and regulatory issues, and then there are the behavioral issues. First of all, we have had an unbelievably long, low interest rate environment that has gotten people to take more risk in the stock market, looking for income and looking for returns. And, if you remember just a year ago, how much could you get on your savings account? And consequently, we had a mismatch, because meanwhile, banks like Signature, but really Silicon Valley Bank, were investing in long-term treasury bonds, 10 years, 30 years, to try to make some more money on their deposits. And that had worked great for a long time. The problem is, because there is an inverse relationship between interest rates and bond values, when interest rates start to go up, bond values go down. And that's one of the big financial problems that happened for Silicon Valley Bank. The bonds that they were holding went down in value, and then if they needed to sell some of those to provide reserves to then provide cash to depositors who wanted to withdraw money, they had to take a loss. Now, there's more to talk about with that, but that low interest rate market for many years now had lulled a lot of companies and lots of investors into going with longer term bonds where you could make a higher interest rate. The other thing that's coming out now that's interesting, and as a business owner, I can really appreciate this. If you have loans with a bank as a business, they often have what are called covenants that you have to agree to. And one of the unusual covenants that Signature, actually, again, Silicon Valley Bank put into place was that you had to keep more of your deposits in the operating account with their bank. And that's pretty common, that you have to have your operating or checking account as a business with the bank that is providing the loans to you. But in this case, Silicon Valley Bank was requiring their depositors, their business owners, to hold even more of their cash reserves at the bank, which made it very possible to go over that $250,000 FDIC insurance level. Now, to be clear, and I think we're going to hear more about this, there was definitely some poor management, and what has come out in the last couple of days is that they did not even have a head of risk management looking at the bond issues, looking at the possible what-if scenarios that could happen if all of a sudden a lot of their depositors wanted to access their money. They now have somebody in place, but obviously a day late and a lot of dollars short, and so that is certainly unacceptable. And as a shareholder in the stock, that's why you lost your money. Now, one of the other things that's coming out is that the Federal Reserve and other regulatory authorities were looking at both Signature Bank and at Silicon Valley Bank. But for whatever reason, as they wrote them up and indicated their concerns about what was going on, action wasn't getting taken. So we could take that back to poor management again. That, I think, remains to be seen, and there's going to be plenty of investigations about that. And then what really started to bring the end to a close very quickly was how quickly the Federal Reserve, in an effort to fight reasonably inflation, because they do believe inflation can really hurt the economy and can really hurt individuals in our country. They once they decided that inflation was a problem, they started to raise interest rates very quickly. And so all of a sudden we had a situation where those bonds that Silicon Valley Bank was holding all of a sudden didn't look so good. In the case of Signature Bank, what was also happening was that they had been working with a lot of crypto currency investors. Not that they were really involved in the trading, but as we all know, cryptocurrencies have dropped a great deal. And so needing to get cash, all of a sudden you start to have this run on cash. And so there were a number of complicated things. It's easy to assign one issue or another, but there were really multiple things going on at the same time. The other thing that you may not think about as an individual depositor, but we think about as a business, is that it's very easy, if you have a successful business, to exceed the $250,000 FDIC limit. And it's not that easy to go set up bank accounts all over town to spread your money. Not to mention it becomes complicated transferring monies back and forth to meet payroll, to cover other expenses. And so that's something else to keep in mind, because you may be thinking, well, why didn't these businesses spread their money out? That's not what most people who are running a business do. Now, are businesses thinking about that? You betcha, including ours. Now, those were the financial and regulatory issues, but there were a number of behavioral issues that I think are worth mentioning. There's a term that goes back to 2008, 2009. A book was written about it, really worth reading, called Willful Blindness. And there was clearly some willful blindness, whether it was the bank management, who knows on the regulators yet. And there was an overconfidence. If you recall, there was a narrative out there for much of last year where certainly the stock market kept hoping that the Federal Reserve would raise interest rates, they would slow things down, and then they would turn around and they would cut interest rates. And honestly, that has not happened. And it's very possible that there was some overconfidence at both of these banks' managements, but especially Silicon Valley, where they thought, okay, we can write out the losses on our treasury bonds, and then when the Fed stops raising rates and maybe cuts them, then we're going to make up our losses and we'll be okay. Obviously, that thinking did not pay off. And then the last two honestly involve the depositors. First, herd mentality. Word got out on the street with venture capitalists and their clients, throughout the real estate investors in New York with Signature Bank. Word got out so quickly in social media that unlike a normal bank run where you would actually have to go to the bank and you would go to try to get your money out of the bank, there was just a herd mentality of people not doing their research, not checking, and just running for the doors. And then if you add the beauty of your cell phone and the ability within seconds to be able to transfer money from one place to another, you have a really 2023 bank run in an unimaginable quickness and magnitude, which is what we saw, billions and billions of dollars moving in the span of a day, like nothing else we've ever seen before. And so a lot came together to make this happen. And it's not easy to pinpoint one issue, but is it worth thinking about what we might do differently? Absolutely. So what can you do? Well, we would say at Omega that it's time for a personal and financial risk assessment. And we are happy if you're working with Omega to sit down, take a look at your banking situation, and really make sure that you've got things in order. First of all, one of the easy things is to consider multiple or different titled accounts at your bank. So for each different titled account, if you have a revocable trust or an individual or payable on death account or a joint account, each of those are insured separately. And for many of our clients who work with us at Omega, that would be very possible. And that might be the first thing to do rather than starting to spread your money across a whole bunch of banks. And I know there's a few clients out there that have done that. And the one thing that we want you to think about, because we're in the process of working with a number of families who are settling estates for their loved ones who have passed away. Having money at a whole bunch of different places can be very complicated to keep track of. Remember passwords so that you can do that electronic transfer. And then, God forbid, something happens to you and now your family has got to go to each of these financial institutions to deal with closing things up and transferring assets. So, unless you're exceeding, that 250, first of all, you're not really going to have there really isn't that risk, especially if you're just not keeping that much cash. But for those of you who are keeping more than $250,000 at a bank, then it's time to look at some different options, maybe a second bank, multiple or different titled accounts, and then some other resources that we've talked about with our clients in the past are considering resources like Max My Interest that allows you to set up through their platform. So it's a lot easier system, different accounts at a whole bunch of banks to ensure that you have that protection. And then other options that we can personally help you with are brokered CDs, basically certificates of deposit with various bank accounts to spread out the risk, either through SEI, our investment partner, or our other partner that we work with sometimes, Charles Schwab Institutional. So we've got some options in-house. And honestly, SEI is paying a pretty good rate on their money market right now. And they are a trust company, so your assets are protected in a very different way. So if you want to learn more about that, don't hesitate to reach out to us. And then finally, and this is what I refer to for our business owner clients or anybody who might be watching this, it might be time to consider another banking relationship just as a backup. It was incredibly difficult for some of these businesses to just go out on last Wednesday or Thursday or Friday and attempt to get a business bank account set up. One quote I did hear for those who are inventing Anna Sorokin fans, she said that she was able to get an account set up at Signature. That probably should be a warning sign. because of course she created a lot of fraud across a number of New York financial institutions. It's not that easy to set up a business bank account overnight, so it's something where you need to plan ahead. You're probably not going to want to spread your money too many different places, but having a second relationship is really important. If you do have a loan arrangement with your current bank, often they are going to have covenants where they are going to want you to maintain your operating account there, but that doesn't mean you couldn't move some money around just to have a backup, a plan B. So there's a number of things that you can do. The most important thing is to not panic. Secondly, understand if there is any risk for you, and then talk with us. We're happy to do that personal financial risk assessment to make sure that that cash money that you've got is as secure as it possibly can. I hope you found this to be helpful, and look forward to talking with those of you where we can be of assistance as you look at your overall financial situation. Take care.